Have you ever had that little voice in the back of your head, maybe late at night when you're looking at your portfolio, that asks, what if this brokerage firm just vanished? It's a scary thought, for sure. But there's actually a safety net designed for that exact scenario. Today, we're going to demystify it. We're talking about the Securities Investor Protection Corporation, or as you'll hear it called, SIPC. It all boils down to a really fundamental question, one that I think every single investor has wrestled with at some point. Are my investments really mine? And if they are, just how safe are they? And look, this isn't just some abstract fear. This is real. Here's a quote from an investor on Reddit that just nails it. I always thought that by investing, I am buying ownership, not that somehow the brokerage also puts me at risk. It's a super common worry. And honestly, it gets right to the heart of why this whole system even exists. So let's break down the core problem here. What is the actual risk that this whole thing was built to solve? Okay, here's the deal. The stocks, the bonds, the ETFs you buy, they are legally your property. Your brokerage is just the custodian. They're holding them for you. The real danger isn't about ownership. The risk, the absolute nightmare scenario, is that the brokerage firm fails. Their books are a total mess, and your assets are just gone, missing. That's what we're trying to prevent. And it was that exact nightmare that forced the creation of a pretty powerful safety net for investors. To really get it, we've got to jump back in time to the late 1960s. The market was booming, but it got hit by something they called the paperwork crunch. Basically, trading volume exploded, and the back office systems of the day just couldn't keep up. It was chaos. Hundreds of brokerage firms went belly up, and investor confidence was absolutely shattered. So in 1970, Congress had to step in. They passed the Securities Investor Protection Act, and from that, the SIPC was born. So we have this safety net, but how does it really work? Let's dive into the fine print and actually look at the rules of the game. All right, so at its core, SIPC is a nonprofit. It's not a government agency, it's actually funded by its member brokerage firms. And it has one very specific job. If one of its member firms fails and your assets are missing, SIPC steps in to make you whole, to restore your cash and securities. And here's the number you've probably heard before, $500,000. That's the headline figure. SIPC protects you up to a total of $500,000 for the combination of securities and cash in your account. But, and this is a really important but, within that $500,000 umbrella, there's another limit. SIPC only covers up to $250,000 of that for cash that's just sitting in your account uninvested. Now, this next part is huge because this is where a ton of confusion comes from. People mix up SIPC and the FDIC all the time. But it's simple, really. The FDIC protects your cash in a bank account if the bank goes under. SIPC protects your investments in a brokerage account if the broker goes under. Different institutions, different protections. And we have to be crystal clear about what SIPC does not do. It is not your get-out-of-jail-free card for a bad investment. It won't cover your losses if a stock you picked goes to zero. It doesn't cover things like unregistered crypto or commodities or fixed annuities. It's there for one specific risk, your broker failing, not your investment strategy failing. And here's a little pro tip on how that coverage works. The protection is applied per customer, per separate capacity. What does that mean? It means your individual brokerage account, a joint account you have with a spouse, and your IRA are all treated as separate buckets. So each one gets its own $500,000 layer of protection. Okay, so the theory sounds pretty solid, but how has SIPC actually held up in the real world under pressure? Let's check out its track record during some of the biggest financial crises we've ever seen. And you can't talk about a true stress test without talking about 2008. The financial crisis was a full-blown meltdown that caused some of the largest, most complicated brokerage failures in history. And you can see SIPC was right in the thick of it. When Lehman Brothers collapsed, SIPC was instrumental in getting over 110,000 customer accounts transferred, making sure over $100 billion in assets got back to the rightful owners. And then, of course, there's the infamous Bernie Madoff Ponzi scheme. SIPC was on the front lines there too, recovering and distributing over $14 billion to the victims. They were tested by fire. So what does all that action add up to? Well, the track record is pretty incredible, actually. Since it was created back in 1970, SIPC says that in the cases it's had to handle, no fewer than 99% of eligible investors got their investments back. Okay, we've covered a lot of ground. The history, the rules, the big tests. So what's the bottom line? What does this all mean for you, the individual investor? Well, it really just comes down to 3 simple but absolutely critical steps. 1. Confirm your brokerage is a SIPC member. It's usually right there on their website. 2. Understand those coverage limits, the $500K total, $250K for cash. Know the rules. And 3, and this one's on you, keep your own records. Save those trade confirmations and account statements. They're your ultimate proof of ownership. Which kind of leaves us with one final thought, doesn't it? SIPC is there to protect you from a failed broker, but who protects you from not knowing the rules in the first place? That's a question only you can answer by staying informed and doing your homework. And as always, while we've laid out how the system works, remember, this is not financial advice.